Welcome back to The Deep Dive, the show engineered to turn complexity into strategic knowledge. Today, we are undertaking a really deep dive into IFRS 16, leases. This standard isn't just another topic, it's really a modern pillar of financial reporting. And look, if you're gearing up for your professional exams, getting this material down cold is, frankly, non-negotiable. Now, for you, our dedicated listener, deep in your ACCA studies, our mission today is absolutely clear. We're moving beyond just, rote memorization. We are going to strategically dismantle IFRS 16. We want to understand the core logic, the why behind it, and then focus really intensely on the how. That means getting full command of the calculations you need, the precise journal entries, and those tricky contextual questions examiners just love to throw at you about right-of-use assets and lease liabilities. We really need to build your confidence so you can apply these rules under pressure.
And that strategic focus is spot on because, honestly, IFRS 16 represents probably the largest single change in balance sheet reporting in, the last 20 years. It directly tackles a gaping hole that previously allowed huge commitments to be kept off the books, that fundamentally misled anyone trying to figure out a company's true gearing or its solvency. We'll show exactly how the standard ties straight back to the conceptual framework, making it not just some rule to follow, but a principle you really need to understand.
Okay, so let's unpack this properly. Let's lay the groundwork first. Why did the IASB, the International Accounting Standards Board, feel they absolutely had to bring in this, let's face it, complex new standard? It all starts with the problems, the shortcomings of the old standard, IAS 17. What was the real core issue there?
The core problem, fundamentally, was a behavioral one. It was driven by a loophole, really, off-balance sheet financing. Under IAS 17, as you know, leases were split in two. They were either finance leases, and those were capitalized, shown on the Statement of Financial Position, the SFP, correctly enough, or they were operating leases, and these were just treated like simple rental expenses running straight through the profit or loss, the P&L.
Right, and companies, especially in certain sectors, I'm thinking retail, airlines, shipping, those kinds of capital-intensive industries, they got very good very quickly at structuring their big long-term contracts. For property, planes, machinery, they structured them to fall just short of the really strict criteria needed to classify them as a finance lease.
Precisely. They actively, tweak the terms. Things like the lease term length, the present value thresholds, maybe guaranteed residual values, all designed to keep these agreements classified as operating. And the result? Businesses could have obligations literally worth billions, genuine claims against them needing future cash outflow that just never showed up on the balance sheet. They were essentially debt obligations hiding in plain sight, maybe mentioned in the footnotes, if you looked hard enough.
Okay, so this brings us right back to the conceptual framework. You mentioned earlier it violated faithful representation. Can you unpack that a bit more? Which specific elements of faithful representation were really compromised by that old IAS 17 structure?
Oh, the violation was pretty severe, actually, across several components. The main victim, I'd say, was completeness. Faithful representation demands that financial statements be complete, right? Including all the necessary descriptions and explanations. So by allowing these huge long-term claims, liabilities, and the corresponding economic resources, the assets you get to use, to just be left out, the statements were, inherently incomplete. And beyond that, it also compromised neutrality. You see, the structure allowed management to choose an accounting outcome, the off-balance sheet treatment that painted a better picture of their leverage, their debt levels, rather than choosing an outcome that objectively represented the economic reality of their future commitments. This ability to engage in, let's call it creative accounting, where the legal form won out over the economic substance that was the key failure, IFRS 16, was really designed to stop.
Okay, so IFRS 16 steps in, forces this economic reality onto the page. It sets up what you call the universal model for the lessee, the company using the asset. So no more classification games for the lessee side. What's the fundamental rule now?
The fundamental mandate is pretty simple in concept. If a company controls the use of a specific identified asset for a period of time, and does so in exchange for payment, basically, if it is a lease, then it must be recognized on the balance sheet, full stop. The lessee recognizes an asset that's the right to use the underlying thing and a liability, representing the obligation to make the lease payment.
So that's the main rule. But like all rules, there are those crucial exceptions, the ones you absolutely have to know inside out because, let's be honest, they're perfect for those quick-fire exam questions. What are the two key exemptions that let a lessee still just expense the payment straight to P&L?
And they are pretty tightly constrained. First, you've got short-term leases. Now, this means leases with a term of 12 months or less. But, and this is a critical catch, they must also contain no purchase options. So if you've got a 10-month lease, but the contract says you can buy the asset at the end, nope, exemptions off the table. You have to capitalize it. Second is low value assets. This applies to assets that had a low value when they were new. The standard setters deliberately focused on the value when new to avoid companies having to constantly reassess value. Think things like laptops, small office gear, maybe some minor furniture, those sorts of things.
And the election itself is important too, isn't it? For short-term leases, you have to apply that election to an entire class of underlying assets. Whereas for low-value assets, you can make that choice on a lease-by-lease basis.
Exactly right. That low-value election gives you more flexibility, really for practical reasons. You might decide to capitalize an expensive server, but just expense, say, 50 small office printers individually.
Okay. And if a company does successfully elect one of these exemptions, they get to skip the whole complex capitalization thing. The accounting goes back to that simpler, systematic approach, a bit like the old IAS 17 operating lease method. Let's maybe talk through the mechanics of that simpler accounting. Use the banana and mango example from the material. Focus on how that systematic allocation works, even when there are incentives involved, like a rent-free period.
Yeah, that's a perfect little illustration of the allocation principle. So Mango leases a machine from Banana. It's a 4-year contract, and they elect the low-value exemption, let's say. The annual payments are set at $2,000, but Mango gets an incentive, a rent-free period in the first year.
Okay, so let's track the cash. Cash outflow is year 1, $0. Then year 2, $2,000. Year 3, $2,000. And year 4, $2,000. So the total nominal cash cost over the 4 years is $6,000.
Right. But the standard requires that the total cost, that $6,000, must be recognized on a straight-line basis over the lease term. That ensures a systematic allocation. So we calculate the total expense. $6,000 total cash divided by the 4-year term equals $1,500 annual lease expense. That $1,500 hits the P&L, the profit or loss statement, every single year for 4 years.
Let's quickly track the balance sheet effect year by year, because this really highlights the difference between the expense recognition and the actual cash flow.
Okay. In year 1, Mango recognizes that $1,500 P&L expense, but the cash paid is 0. Since the expense recognized is more than the cash paid, Mango immediately creates a $1,500 accrual or liability on the statement of financial position. This liability basically represents the deferred payment obligation arising from that rent-free incentive.
Makes sense. Okay, year 2, Mango again recognizes $1,500 P&L expense, but this time cash paid is $2,000. So the cash paid is now $500 more than the expense recognized for the year.
Exactly. And that $500 excess cash payment then starts to unwind the liability we created in year 1. The $1,500 opening liability is reduced by that $500 difference, leaving a closing liability of $1,000 at the end of year 2. And the same process just repeats for the next couple of years.
So, year 3. Expense is $1,500 again. Cash paid is $2,000. So another $500 difference reduces the liability. The opening liability of $1,000 goes down to $500.
And finally, year 4. Expense $1,500, cash $2,000. That final $500 excess payment reduces the remaining liability of $500 right down to 0. And look, the total $6,000 cost is perfectly matched to the 4-year period, systematically smoothing out those uneven cash flows caused by the rent-free period. That's the model you follow if you correctly elect an exemption.
Right, that systematic method is straightforward enough. But realistically, most leases won't qualify for those exemptions. They'll fall under the main universal model. Which means we trigger the dual recognition principle right at the start, at commencement. We recognize both a right of use, ROU asset, and a lease liability. Let's tackle the liability first, because calculating that correctly is really the foundation for everything else.
Yeah, the lease liability calculation is definitely where things get more complex, mostly because it involves the time value of money, discounting. And that's often where students, trip up. It's measured at the present value PV of the lease payments that are expected to be payable over the entire lease term. You absolutely cannot just add up the future payments. That's a fundamental error.
Okay, so we need to be super clear on exactly what payments get included in that PV calculation. What are the mandatory components we need to factor in?
Right. There are 5 key components you need to consider for the cash flows that get discounted. 1, fixed payments, obvious enough, but make sure you adjust these down by any lease incentives received from the lessor. 2, variable payments, but only those that are based on an index or a rate. Think payments tied to inflation, like the CPI or maybe market interest rates. Crucially, variable payments that depend on future performance or usage, like a percentage of future sales from a store, or payments based on machine hours, those are excluded from the initial PV calculation. They just get expensed as they happen. That's a really common distinction tested in exams. 3, the amount you expect to pay under any residual value guarantees that the lessee, the company using the asset, has made. 4, the exercise price of a purchase option, but only if the lessee is reasonably certain they're actually going to exercise that option to buy the asset. And 5, any penalties for terminating the lease early, again, only if the lease term assessment already assumes the lessee will exercise an early termination option.
Got it. That covers the payments. Now the how, the rate. We need a discount rate to actually calculate the present value. What's the hierarchy here? Which rate do we use first?
Priority number 1, always, is the rate implicit in the lease. Conceptually, this rate is the internal rate of return, the IRR, that the lessor is actually achieving on the whole transaction. It's the specific rate that makes the present value of the minimum lease payments plus any unguaranteed residual value equal to the fair value of the asset being leased plus any initial direct costs the lessor incurred.
That sounds incredibly specific. And often, wouldn't the lessee just not know all that information, like the listor's costs or the residual value estimates?
Exactly. That's the practical problem. The lessee often just cannot readily determine that implicit rate because the inputs like the lessor's initial costs or their unguaranteed residual value figure, that's usually proprietary information, or simply unknown to the lessee. So when that happens, and honestly, this is very often the case in exam scenarios, the lessee must use the secondary rate, their own incremental borrowing rate. And the incremental borrowing rate is defined quite specifically, too. It's the rate of interest the lessee would have to pay if they were to borrow funds on a secure basis over a similar term to purchase a similar asset outright. Basically, it's the company's specific cost of borrowing for that kind of asset and term. And usually in a complex exam calculation, this is the rate they'll actually give you.
Okay, so once we've wrestled with that and figured out the lease liability using the PV of those defined payments and the correct rate, then we move on to the ROU asset. How do we measure that asset initially?
Right. The ROU asset is basically a composite figure. It represents the total cost incurred to get that right of use asset ready. It's made up of 4 main elements typically. 1, the amount of the initial lease liability, we just calculated that PV of future payments. 2, plus any lease payments made at or before the commencement date, like an initial deposit or the first payment if it's made right at the start. We'll come back to that critical point. 3, plus any initial direct costs incurred directly by the lessee. Think broker fees, maybe stamp duty, legal costs associated with setting up the lease. 4, plus the estimated cost for dismantling, restoring, or removing the asset at the end of the lease, but only if the lessee has an obligation to do so. These costs themselves need to be estimated and discounted according to other standards like IAS 37 and IAS 16. And finally, 5, minus any lease incentives received before the commencement date, say if the lessor gave you some cash back up front.
Okay, that structure leads us perfectly into our first major exam pitfall discussion, the PV confusion, as you called it, where the timing of that very first payment can fundamentally change the whole calculation. Let's walk through the Peach illustration from the material in detail to see this.
Yeah, this is a classic. So Peach leased some equipment for 5 years, starting 1st January 2019. They made a cash payment of $4,000 on that date, 1 January 2019, upfront. They will then make 4 more annual payments later on. The implicit rate was given as 3%. Now, the absolute key piece of information provided is this. The present value of the future lease payments is $14,868.
Okay, why is that specific phrasing, future payments, so absolutely critical here?
Because the whole concept of present value, PV, inherently means discounting a stream of cash flows back to time 0, to the start date. If the calculation yielding $14,868 only covers the 4 future payments, the ones made at time 1, time 2, time 3, time 4, then the payment made at time 0, the $4,000 paid on day 1, well, it's already at its present value. It happened at time 0. It requires 0 discounting.
Right. So the journal entry on that first day, 1st January 2019, has to recognize the full economic reality, the full obligation, and the full cost of getting that ROU asset.
Absolutely. The initial lease liability needs to recognize the obligation related to those future payments. So the liability starts at $14,868. That's the PV of what's still owed. However, the total cost used to measure the ROU asset has to include everything spent initially. That includes the initial $4,000 cash payment made right on that day. So the ROU asset is measured at the PV of future payments plus the initial payment, $14,868 plus $4,000, $18,868. $4,868.
Okay, but wait a second. How does the initial lease liability balance square with this? If the total ROU asset cost is $18,868, but we just paid $4,000 in cash,
Yeah.
how does the initial journal entry actually work? Does the liability start at $18,868 and immediately reduce?
Good question. This is where we need to be precise with the double entry. We separate the ROU asset calculation from the initial liability movement caused by the first payment. On 1st January 2019, the journal entries would look like this, effectively in sequence. First, you figure out the components. ROU asset total cost is $18,868. Initial liability, PV, of future payments is $14,868. Cash paid is $4,000. So the net entry is 1. Debit ROU asset, $18,868, recognizing the total cost. 2. Credit cash, $4,000, reflecting the payment made today. 3. Credit lease liability, $14,868, recognizing the remaining discounted obligation for future payment.
Oh, okay, that clicks. The RU asset captures the full initial investment value, but the lease liability only captures the part of the obligation that's still outstanding after that initial payment has been made. So if a student just carelessly put $14,868 for both the asset and the liability, they'd basically be losing $4,000 of the asset's cost base and also understating the total financing involved. Big error.
Correct. It's a very common mistake. Always check the payment timing. Are the payments in advance, like Peach, or in arrears at the end of each period? If, hypothetically, that first $4,000 payment was due on 31 December 2019 in arrears, then the $14,868 PV calculation would likely already include the discounted value of that first payment. In that case, the initial ROU asset and the initial liability would both likely be $14,868. Timing is everything.
Right. Initial recognition is vital, setting the stage. But let's be honest, most of the really heavy calculation work in the exam usually centers on subsequent measurement, how these asset and liability balances change over the years. Let's start with the ROU asset. How's that handled after day one?
Yeah, the ROU asset subsequently is treated pretty much like any standard property, plant, and equipment item under ILS 16. It's carried at cost less accumulated appreciation. Simple enough in theory. The main exam trap here, though, is figuring out the correct depreciation period.
Okay, let's nail down the two key rules that govern that depreciation period. It depends on whether ownership is expected to transfer at the end.
Exactly. Two scenarios. One, if ownership transfers by the end of the lease term, maybe it's explicitly stated in the contract, or maybe there's a purchase option the lessee is reasonably certain to exercise, then you depreciate the asset over its full useful life. The logic here is the entity expects to use the asset pretty much indefinitely, just as if they bought it outright from the start. 2, if ownership does not transfer. In this case, the ROU asset must be depreciated over the shorter of the asset's own useful life and the lease term. Why? Because the entity's legal right to actually use the asset stops at the end of the lease term. So its value to the lessee is limited by that shorter period, regardless of how long the asset could physically last.
Okay, let's apply that rule directly to the Plum machinery example. Plum leased machinery for 5 years. The machinery itself has a useful life of 6 years. And the scenario doesn't mention anything about ownership transferring.
Right. So we compare the two periods. Lease term is 5 years, useful life is 6 years. We have to use the shorter period. Therefore, Plum's ROU asset must be depreciated over 5 years. Now, if the ROU asset was initially calculated at, say, $23,230, which, according to the source material, included the initial liability, some direct costs, etc., and assuming they use straight-line depreciation, the annual depreciation expense hitting the P&L would be $4,646. That's just $23,230 divided by 5 years. And that $4,646 expense would be consistent year after year.
Okay, that's the asset side. Relatively straightforward once you've picked the right period. Now, the liability side, that's the beast, isn't it? The lease liability has to be accounted for using the amortized cost model.
Yeah.
This is where the effective interest method comes into play, the bane of many students' lives.
Yes, it is, and you have to get comfortable with it. Essentially, every single annual payment made is like a mixed payment. Think of paying off a mortgage or a loan. It has to be split into two distinct parts. One part is the finance cost, that's the interest expense, recognized in the P&L. The other part is the capital repayment, that's the principal reduction, which lowers the liability balance sitting on the SFP.
And doing this correctly requires mastering the amortized cost table.
Yeah.
I mean, this is probably the single most important working students need to practice repeatedly. Let's walk through the first couple of years for the Plum machinery liability. Assume the initial liability balance was correctly calculated as $22,730. The implicit interest rate is 5%. And crucially, the annual payments are $5,000, made in advance, so right at the start of each year.
Okay, that in advance timing is absolutely critical here. Let's track it. Year 0, 1 January 2015 commencement date. The initial liability balance is established at $22,730. Now, because the first $5,000 payment happens immediately at commencement, this payment reduces the principal before any interest even starts to accrue for the first period. So, opening liability, PV, $22,730, less initial payment made day 1, $5,000. Balance subject to interest for year 1, $17,730.
Okay, right. So $17,730 is the actual amount of principal that the lessor is effectively financing for Plum over the next 12 months. Now, how does the interest for year 1 accrue on that amount?
Year 1, covering the period to 31 December 2015 year end. Interest for the first year is calculated on that $17,730 opening balance after the initial payment, interest expense for P&L in year 1. $17,730 times 5% equals $887. That's around slightly if needed. So the liability grows by the interest accrued during the year. Liability closing balance at 31 December 2015, $17,730 opening plus $887 interest equals $18,670.
Got it. So the balance sheet liability shown at the end of year 1, 31 December 2015, is $18,617. And importantly, no cash changes hands at the end of year 1 because the payments are structured to be in advance. The next cash payment happens right at the start of year 2.
Exactly. So year 2, 1 January 2016, second payment date. The liability balance carry forward is $18,617. The lessee, Plum, makes the second $5,000 payment on this day. Again, this payment immediately reduces the principal balance before year 2 interest starts accruing. Liability before payment, $18,617. Less payment made day 1 of year 2, $5,000. Balance subject to interest for year 2, $13,617.
And if we think about that $5,000 payment conceptually, $887 of it went to cover the interest that accrued during year 1, and the rest, the remaining $4,113, $5,887, actually reduced the principal down to that $13,617.
Right.
Let's track the interest for year 2 now.
Right. Year 2, covering the period to 31 December 2016 year end. Interest for the second year is calculated on the new opening balance for the year, that $13,617 interest expense for P&L in year 2. $13,617 times 5% or size $681, again, rounding slightly. And the liability grows again by this interest. Liability closing balance at 31 December 2016, $13,617 opening plus $681 interest equals $14,298.
Perfect. And we can already see that pattern emerging. The interest expense is declining year on year, $887 in year 1 down to $681 in year 2. Why? Because it's calculated on a reducing principal balance. This really confirms that front-loaded nature of the total expense under IFRS 16 compared to the old flat rent expense.
Yeah.
Now, this amortized cost table serves a second really crucial purpose for exams: SFP disclosure, the split between current and non-current liabilities. How do we use this table to figure out that split as at, say, 31 December 2016?
Good point. You need to look forward 12 months from the reporting date. You need to figure out how much of the capital, the principal, is due to be repaid in the next 12 months. So at 31 December 2016, the total liability stands at $14,298. We know the next payment is $5,000 due right on 1 January 2017, start of year 3. Now, that $5,000 payment due on 1 Jan 2017 covers two things. It covers the interest that just accrued in year 2, the $681, and the remainder is the capital repayment for that year. So the capital repayment portion that's due within the next 12 months, i.e. during 2017, is $5,000 total payment minus the $681 interest component is $4,319.
Okay, so the current liability that needs to be shown on the statement of financial position at 31 December 2016 is precisely that amount, for $4,319. That's the slice of the principal balance that will be repaid in the upcoming year.
Exactly right. And the non-current liability is simply the rest of the principal balance after accounting for that expected repayment. You take the total closing liability at 31 December 2016, $14,298, and subtract the current portion, $4,390. That gives us $14,298 by $4,319 and $9,979 as the non-current liability. And honestly, this step identifying the capital repayment component due in the next 12 months from the table is pretty much a guaranteed exam component. It tests if you really understand how the amortized cost table works and basic SFP disclosure rules. Don't skip practicing this.
Okay, let's zoom out again for a moment and look at the overall P&L impact. We've clearly established there are now two distinct expenses hitting the profit or loss under IFRS 16 for the lessee: the depreciation on the REU asset and the finance cost interest on the lease liability. How does this dual expense structure typically affect core profitability metrics when you compare it back to the old simple straight-line rent expense model under IAS 17?
Yeah, the shift has two really major effects on the P&L presentation. First, EBIT, or operating profit, is generally lower in the early years of the lease. Why? Because the ROU asset depreciation expense is usually pretty constant, like the $4,646 in our Plum example, and that depreciation charge often tends to be higher than the capital repayment part that was sort of hidden within the old single operating lease expense figure. And critically, that depreciation expense sits above the interest line in the P&L, reducing operating profit directly. Second, as we saw with the interest calculation, the total P&L expense is front-loaded because the interest expense, the finance cost, is highest when the liability balance is highest, which is in the early years. Remember, $887 interest in year one versus $681 in year two for Plum. The total combined P&L hit, depreciation plus interest, is higher at the start of the lease and then gradually decreases over time. Under the old IAS 17, that single rent expense was perfectly level year after year. So this front loading definitely affects things like net profit margins and earnings per share, making profitability look a bit worse initially under IFRS 16.
Right. So if an analyst is trying to compare two companies, maybe one that adopted IFRS 16 early and one that's still showing comparatives under the old rules, the IFRS 16 company could look simultaneously more leveraged on the balance sheet and less profitable on the income statement, at least in the early phases of its major leases.
Absolutely. The transparency about the liability is definitely there now, which was the goal. But the resulting financial optics, especially in the early years, are certainly tougher, which, let's be frank, is why this standard faced quite a bit of resistance from management teams around the world when it was introduced.
Okay, now that we've really dug into the lessee accounting, which is the main focus for FRSAMs, let's just briefly turn our attention to the other side of the coin. The lessor, the entity providing the asset. Now, the lessor's counting under IFRS 16 is fundamentally different from the lessee's approach we just discussed. Why did the standard setters decide to keep the old dual classification model, finance lease versus operating lease for the lessor?
Yeah, that's a really crucial distinction to grasp. Remember, the lessee is primarily measuring a liability and obligation they have to pay. The lessor, on the other hand, is measuring an investment they've made, or maybe just a continuing asset they own and are renting out. The standard setters basically concluded that keeping the dual model provided more relevant information for the lessor about the underlying nature of that investment or asset arrangement. So if the lessor transfers substantially all the risks and rewards associated with owning the asset, which defines a finance lease, then they are, in economic substance, making a sale and providing financing to the lessee. Their measurement objective shifts. They stop thinking about the asset itself and start recognizing a receivable, their net investment in the lease. They actually de-recognize the asset they leased out and then recognize interest revenue over the lease term based on that receivable.
Okay. And if the lessor retains most of the risks and rewards, making it an operating lease from their perspective,
then it's much simpler, much more like a straightforward rental. They keep the underlying asset on their own statement of financial position. They continue to depreciate it themselves, and they recognize the rent payments received from the lessee as income, usually on a straight line basis, directly into their P&L. So that old IAS 17 classification test, the one based on assessing the transfer of risk and rewards of ownership, that remains absolutely vital, but only for the lessor's accounting.
Right, good clarification. Okay, now for what might be the grand finale of complexity in this area, sale and leaseback transactions. We know these are used pretty extensively in practice companies selling buildings or equipment and then immediately leasing them back. And they are definitely a frequent heavy hitter in professional exams. So a seller lessee sells an asset to a buyer lessor and immediately leases it right back.
Exactly. And the entire accounting treatment for the seller lessee hinges on one critical question first. Did the initial transfer of the asset actually meet the criteria to be recognized as a sale under IFRS 15, revenue from contracts with customers?
Okay, let's consider scenario one. It's not a sale because the transfer fails those IFRS 15 criteria. What kind of criteria might cause it to fail in this context?
Well, IFRS 15 is all about the transfer of control. So if the leaseback terms are structured in a way that suggests the seller lessee hasn't really given up control, for example, maybe they retain an option to repurchase the asset at a very low fixed price. Or conversely, maybe the buyer lessor has the right to force the seller lessee to repurchase it at a high fixed price later on. Either of those might indicate that the buyer lessor never truly gained control over the asset's future economic benefits or risks. If that's the case, economically, the whole thing looks much more like a loan secured against the asset, rather than a true sale and leaseback. So if the transfer fails those IFRS 15 control criteria, the seller lessee must treat the entire arrangement purely as a financing transaction. They keep the original asset on their SFP and continue depreciating it as before, and they simply recognize a financial liability equal to the cash proceeds they received from the sale. The subsequent lease payments they make are then treated just like principal and interest payments on that financial liability. The sale part is essentially ignored for accounting purposes.
Right. So no ROU asset gets recognized. No gain or loss on sale gets recognized. It's treated purely as a secured loan. Simple enough, conceptually.
Exactly. But the much more common examinable scenario, the one that requires that tricky, sophisticated proportional calculation, is scenario 2. It is a sale because the IFRS 15 criteria are met. And critically, for most exam purposes, we usually assume the sale price is equal to the asset's fair value at the time of sale.
Okay, this is a complex one. It requires, what, 4 simultaneous accounting actions for the seller lessee? Let's break them down. First step.
First, the seller lessee must derecognize the old asset from their books at its previous carrying value, CV. That's the starting point, the value coming off the SFP.
Okay, asset gone. Second step, the new liability.
Second, they recognize a new lease liability. This is measured exactly as we discussed before at the present value of the future lease rental payments they are now obliged to make under the leaseback agreement. Standard IFRS 16 liability calculation.
Right. Third step, recognizing the new ROU asset. Now, this is where that unique proportional calculation comes in. Why proportional? What's the logic?
The logic is that even though the seller lessee has legally sold the asset, they've immediately leased back the right to continue using it for the leaseback term. So they haven't fully given up all rights associated with the asset. They have effectively retained the right of use portion related to the future lease payments. Therefore, the standard says they should only recognize a new ROU asset that reflects the proportion of the previous asset's value they continue to control or benefit from through this retained right of use. So the ROU asset is measured by taking the asset's previous carrying value, the value it just came off the books at, and multiplying it by a specific ratio. The ratio is PV of the lease payments, which represents the value of the rights retained, divided by fair value of the asset, which represents the total value or total rights. So ROU asset, text fair value asset, text fair value of asset, total rate.
Okay, that's tricky. Proportional calculation based on the old carrying value. And finally, the fourth step, recognizing the gain or loss on the sale. You mentioned you can't recognize the full cash gain immediately, only the gain on the rights you actually transferred away.
Correct. Any gain that relates to the portion of the asset use you've effectively retained, the leaseback part, has to be deferred. It shouldn't be recognized instantly as profit. The portion of the gain that is recognized immediately in P&L is calculated by taking the total potential gain on sale, proceeds minus carrying value, and multiplying it by the proportion of rights that were truly transferred to the buyer or lessor. That proportion is fair value minus PV of lease payments representing the rights transferred, divided by fair value. So text recognized gain times fair value, text PV, ACCA PV of lease payments, rights transferred.
Wow, okay, let's try to bring that abstract formula to life using the pair machinery illustration from the material. So pair sold machinery. Its carrying value, CV, was $600,000. They sold it for its fair value, which was also the cash proceeds, of $675,000. They immediately leased it back, and the present value, PV, of those future lease payments was calculated as $625,000.
Right. Let's follow the steps. Step 1, calculate the total potential gain on the sale first. Total gain proceeds, $675,000. Carrying value, $600,000 equals $75,000. That's the overall gain if we ignored the leaseback for a second. Step 2, figure out the proportions of rights retained versus rights transferred. The total value we're comparing against is the fair value, $675,000. The value of the rights retained, represented by the leaseback liability, is the PV of lease payments equals $625,000. So the proportion retained equals $625,000, $675,000. It's roughly 92.59%. The value of the rights transferred is the difference. $675,000 total FV, $625,000. That's roughly 7.41%.
Okay, we have the total gain, $75K, and the proportions, approx. 92.6% retained, 7.4% transferred. Now, we apply these to get the actual accounting entries. Let's start with calculating the new ROU asset value.
Right. The ROU asset is measured based on the proportion of rights retained, but crucially applied to the previous carrying value. ROU asset is $600,000, previous CV, times 92.59% proportion retained, $555,540 approximately. This $555,540 is the value of the new ROU asset that comes onto Pair's statement of financial position.
Okay. And now the gain recognition. We only get to recognize the gain relating to that small 7.41% portion of rights we truly transferred away and didn't lease back.
Exactly. So the recognized gain is $75,000, total gain, times 7.41%, proportion transferred, $5,557 rounded. That $5,557 is the amount that goes immediately to the profit or loss statement in the year of the sale and leaseback.
So what happens to the rest of the potential gain? The difference between the $75,000 total gain and the $5,557 recognized gain, that's about $69,443. Where does that deferred portion effectively go? Is it a separate liability?
No, it's not a separate liability. It's implicitly deferred within the measurement of the ROU asset itself. Think about it. If the ROU asset calculation was simply based on the liability incurred, $625,000 plus any initial costs, it would likely be much higher than the $555,540 we calculated. Because we used the proportional carrying value, $555,540, instead of reflecting the proportional fair value of the rights retained, $625,000 in the asset's initial measurement, the RU asset starts at a lower figure. This effectively spreads that $69,443 deferred gain through lower future depreciation expense over the lease term. The accounting cleverly prevents the seller lessee from booking an instant big profit just by selling an asset they immediately rent most of back.
Got it. That complex proportional approach, linking the old carrying value, the current fair value, and the new present value of the liability. Yeah, that's arguably the most challenging calculation under IFRS 16. Definitely one for students to practice carefully. Okay, we've certainly broken down the mechanics now. Let's shift gears slightly and discuss the real-world implications, particularly how this whole shift to IFRS 16 affects financial analysts looking at company accounts and, by extension, how examiners are likely to test your understanding of these wider impacts. We should start with the most obvious one, the impact on key financial ratios.
Yes, and as we touched on earlier, the biggest shock is definitely to the structure of the statement of financial position. First off, debt ratios almost always suffer immediately upon adoption. Things like gearing ratios, net debt divided by equity, or other solvency ratios, they tend to worsen significantly. Why? Simply because the balance sheet now includes all those previously hidden capitalized lease liabilities as part of total debt. Even if the underlying economics of the business haven't changed one bit, the transparent reporting of these obligations makes the company's capital structure look different. Companies suddenly appear much more leveraged than they did under the old rules.
Right. And on the profitability side, we already noted that front-loading effect of the combined depreciation and interest expense. How does that specifically translate into common profitability ratios like EBITDA, operating margin, and ultimately net profit?
Yeah, the ratio impact on the P&L side is a bit more subtle, but really important for analysis. Remember, under IAS 17, you had a single, usually straight line, rent expense hitting the P&L, typically classified as an operating expense. Now, under IFRS 16, that single expense is replaced by two separate ones: depreciation, which is usually seen as operating, and interest, which is clearly financing. This structural change affects where expenses sit relative to revenue. So, EBITDA earnings before interest, tax, depreciation, and amortization often actually improves after adopting IFRS 16. Seems counterintuitive, right? But think. The old straight-line rent expense was fully deducted before you got to the EBITDA line. Under IFRS 16, that rent expense disappears from there. In its place, you have depreciation and interest. Since neither depreciation nor interest are deducted when calculating EBITDA itself, the EBITDA figure generally looks higher post-IFRS 16 adoption.
Okay, that's a really key piece of analytical insight there. EBITDA might look better, but you said earlier that net profit tends to look worse in the early years.
Precisely. Because the depreciation expense still sits above the EBIT line, earnings before interest and tax, reducing operating profit. And as we discussed with the plum example, in the early years of a lease, the total combined expense, depreciation plus the high initial interest, is typically higher than the old flat straight line rent expense would have been. This leads to lower net profit initially. So analysts have to be really careful when comparing profitability trends over time or between companies, especially if they adopted IFRS 16 at different points. You can't just compare the raw numbers without understanding this effect.
Okay, and finally, let's touch on the impact on cash flow reporting. Under IAS 7, the statement of cash flows. This is another critical point that could easily mislead a superficial analysis.
Absolutely vital point. Under the old IAS 17 rules, the entire cash payment for an operating lease was classified as an operating cash flow outflow. Nice and simple. But under IFRS 16, when the lessee makes their lease payment, that cash outflow has to be split, mirroring the P&L treatment. 1. The part of the payment representing the capital repayment, the principal reduction on the liability, is classified as a financing cash flow outflow. 2, the part representing the interest portion is usually classified as either an operating cash flow or a financing cash flow outflow, depending on the accounting policy chosen by the company. IS 7 allows some flexibility here for interest paid. Now, think about a company with massive historical operating lease commitments, like a big retailer or an airline. By moving that potentially large capital repayment portion out of the operating section of the cash flow statement and reclassifying it down in the financing section, the reported operating cash flow figure artificially improves, sometimes quite dramatically. While the total cash leaving the company haven't changed, metrics that analysts watch closely, like operating cash flow per share, can look substantially healthier, especially in the initial years after adoption, even though the company is still spending exactly the same amount of cash on its leases.
Wow, okay, so the balance sheet looks more indebted, net profit looks lower initially, EBITDA looks higher, and operating cash flow looks higher. That complexity really confirms why IFRS 16 is and will continue to be tested so heavily in exams. Let's try to finalize our strategy then, thinking purely from the student's perspective. What's the examiner testing focus? What are the absolute non-negotiable areas that students must drill and master before they walk into that exam hall?
Okay, if I had to pick the top 3 non-negotiables. First, absolutely, initial recognition and the associated journal entries. Can you correctly identify all the components that go into the initial ROU asset cost? Can you identify all the payments that need to be included in the lease liability PV calculation? And can you actually book the transaction correctly, that basic debit ROU asset, credit lease liability, and handle the cash costs CR doctor correctly? And critically, ensure you understand the impact of payments in advance versus payments in arrears on that initial entry. Second, the amortized cost table. We spend a lot of time on this for good reason. You simply must master the mechanics of calculating the interest expense on the opening liability balance, correctly deducting the cash payment considering timing advance arrears, and deriving the closing liability balance year after year. If you can accurately track this liability movement for, say, 3 to 5 years, you will secure the vast majority of the calculation marks available on a typical lease question. Third, disclosure and classification. This links directly back to the amortized cost table. It means being able to correctly split the final lease liability figure into its current and non-current portions for the statement of financial position. As we showed, that requires pulling out the next year's principal repayment amount from your amortized cost working paper. Examiners also frequently test your understanding of the difference between the depreciation period, shorter of term life usually, and the asset's useful life itself. Get that depreciation rule right.
Okay, those are the must-dos. And to wrap up this section, let's explicitly flag the common student pitfalls, those recurring errors that unfortunately sink otherwise well-prepared students when they face an IFRS 16 question under pressure.
Right. Beyond the really fundamental error of just ignoring discounting altogether, which hopefully no one listening would do, students consistently seem to stumble in 3 more subtle but equally damaging areas. First, miscalculating the initial liability timing and ROU asset. Specifically, failing to correctly treat an initial payment made right at commencement, time 0. Often forgetting to include that payment in the initial ROU asset cost calculation, or failing to reduce the opening liability balance immediately before calculating the first year's interest when payments are in advance. Think back to our peach and plum examples that initial payment handling is key. Second, misapplying the depreciation rule. This is a simple rule, but easily forgotten under pressure. Just assuming straight-line depreciation over the asset's full useful life, even when ownership does not transfer at the end. You absolutely must remember to default to the shorter of the lease term and the useful life in that common scenario, unless the question explicitly tells you title transfers or a purchase option is certain. Third, misclassification of variable payments for the PV calc. This tests careful reading, including all variable payments mentioned in the scenario in the initial present value calculation for the liability. Remember, only variable payments based on an index or a rate, like CPI or interest rates, should be included initially. Those performance-based or usage-based variable payments, like percent of sales or per unit produced, are not included in the initial liability measurement. They are just expensed as incurred later on. It tests if you really understand the precise definition of lease payment for capitalization purposes.
Fantastic summary. So it's clear that truly mastering IFRS 16 requires this sophisticated blend. You need to understand the why from the conceptual framework. You need the technical skills to calculate present values accurately. And you need the discipline to meticulously track that amortized cost model over time, paying close attention to timing and classification details. It is complex, no doubt, but as you say, highly rewarding once you've conquered it. Hashtag tag at outro. Well, what a detailed and, I think, really valuable breakdown of IFRS 16. This standard clearly demands a robust understanding of PV mechanics, of that dual accounting structure with the ROU asset and the liability, and all the nuances of subsequent measurement like depreciation and amortization. Hopefully, by working through these specific calculations, focusing on the timing implications, and highlighting those common pitfalls, you, our listener, are building the strategic knowledge you need, not just to get through the exam question, but actually to confidently analyze how a modern company finances its operations and presents its structure.
And that strategic knowledge really does bring us full circle, doesn't it? We started by talking about why IFRS 16 came about, driven by those core conceptual framework principles of relevance and faithful representation, and we've seen how it fundamentally forced greater transparency onto corporate balance sheets globally. So, maybe for your final provocative thought to take away, we know the shift definitely improved transparency, particularly for sophisticated analysts, but it came at the cost of enormous accounting complexity and, as we saw, those higher reported expenses in the early years of leases, which can distort profitability trends. The big question is, do we believe this massive regulatory intervention truly achieved its ultimate goal of providing significantly more useful information to the average stakeholder, like a typical investor or employee? Or did it primarily end up benefiting those highly specialized analysts who, arguably, could already make reasonably good adjustments for off-balance sheet leases using the old footnote disclosures? That, I think, is the real ongoing debate surrounding the ultimate success of IFRS 16.
An excellent and quite profound thought to chew on as you review these sometimes very technical concepts. Food for thought indeed. Okay, before we sign off, just a final and important reminder for everyone listening. This deep dive is part of the SmartPass study series. We really encourage all of you focused on your financial reporting exams to check out the video description associated with this recording. You'll find links there to SmartPass study resources specifically designed for expert preparation. And, of course, please do subscribe to the SmartPass YouTube channel for more expert insights like this and guided preparation covering all the key IFRS standards and financial reporting topics you need to master. We'll catch you next time for another deep dive.